Welcome to The Explainer. Today, we're diving into a hidden force that can seriously mess with your investment returns. We're talking about currency risk. Think of it as a silent killer that can sabotage even your best stock picks. But don't worry, we're going to show you how to fight back.
So, let's start with a scene that's probably all too familiar if you invest overseas. You've done the research, you've found a fantastic company, and boom, it performs exactly like you hoped. But then you check your account, and the numbers just don't add up. So, what gives?
Okay, here's the math. And yeah, it can be a little painful. Let's imagine you're a European investor. You bought a Japanese stock, and it jumped a solid 10%. Awesome. But over that same period, the Japanese yen got weaker compared to your home currency, the euro. And that shift in the currency's value, it just silently ate more than half of your gains. Your 10% win got knocked all the way down to a sub 5% return. And that right there is currency risk in action.
So how do we tackle this? In today's explainer, we'll start by really defining this risk. Then we'll meet the tool that was built to fight it, the hedged ETF. We're going to look under the hood to see how it works, uncover some of the hidden costs, and then wrap it all up with a really practical checklist to help you decide if it's the right move for you.
Okay, let's get into it. That silent killer we've been talking about, well, it has a name, and just understanding it is the first big step. It's called currency risk.
At its heart, currency risk is the gamble you take whenever you buy an asset in a different currency. All of a sudden, the value of your investment depends on two things: how the asset performs and how its currency performs against yours. And this is a two-way street. A good currency move can juice your returns, but a bad one can do some serious damage to your portfolio.
Which brings us, pretty neatly, to the purpose-built solution designed to solve this exact problem: the Currency Hedged Exchange Traded Fund, or ETF for short.
The whole point of a currency hedged ETF is actually beautiful in its simplicity. It just tries to give you the pure return of the foreign asset, almost like the currency fluctuations didn't even exist. So, if we go back to our Japanese stock example, a hedged investment would have gotten you much, much closer to that original 10% gain because it would have stripped out that negative hit from the yen's fall. And this is a really important but. You got to notice the wording here. The goal is to minimize the risk, not completely eliminate it. The hedge isn't perfect, and that's a key detail. You see, the fund's value is changing every day, but the hedge itself is usually only adjusted once a month. Because of that, little tracking errors can creep in. It gets you super close, but never 100% of the way there.
So how does this tool actually work? What's the secret sauce? Well, it's way simpler than it sounds, and it all comes down to a financial instrument called a currency forward.
Think of it like this. The ETF manager essentially pre-books an exchange rate. They go out and buy the foreign stocks, and at the exact same time, they get into a contract to sell that foreign currency back into your home currency at a price that's locked in, usually for about a month. By locking in that rate, they shield the investment's value from any crazy currency swings during that time. Then each month, they just roll that contract over.
But you knew there was a catch, right? This kind of protection, as elegant as it is, comes with trade-offs. It is not a free lunch. So now we need to pull back the curtain and look at the hidden costs and, yes, the risks. You really have three layers of cost to think about. First, the management fee, the TER, is usually a little higher to cover the extra work of managing the hedge. Second, there's a small transaction fee for the currency contracts, called the bid-offer spread. But it's this third one, the cost of carry, that's the big one. It's an implicit cost that can really impact your performance.
So what on earth is this cost of carry? Well, it all boils down to one simple thing: the difference in interest rates between the two countries. If you're hedging a currency from a country with higher interest rates than your own, that hedge is going to actively cost you money. It'll be a drag on your performance. But, and here's the flip side, if you're hedging from a country with lower interest rates, the hedge can actually give you a small benefit. This is absolutely critical to understand.
This leads us right to the most common assumption people make. You hear hedging, you think reducing risk. So using it must always make your investment safer, right? Well, the answer is surprisingly complicated. Believe it or not, in some situations, getting rid of the currency component actually makes your investment more volatile. You're stripping away something that was secretly acting as a shock absorber. How is that even possible? Just take a look at this real-world example.
This chart shows that for foreign investors in Japanese stocks, the hedged portfolio has actually been more volatile than the unhedged one. Yep, you heard that right. In this case, removing the currency risk actually made the investment riskier.
The reason this happens is pretty fascinating. It's because the yen is what's known as a safe haven currency. It has what's called a negative correlation with its stock market. So when the Japanese stock market has a bad day, investors all over the world tend to pile into the yen for safety, which makes it stronger. For an unhedged investor, that stronger yen helps cushion the blow from the falling stocks. When you hedge, you take that natural protection away.
Okay, so with all these complexities, the costs, the risks, this whole natural hedge thing, how in the world are you supposed to decide what to do? This last section brings it all together into a practical tool. This isn't a simple yes or no, you really need a framework.
All right, here it is, your checklist. Just thinking through these 6 points will get you to the right choice. What's your gut feeling on the currency? Are you dealing with a safe haven like the yen? What's the cost of carry looking like based on interest rates? How much do you personally just hate uncertainty? And finally, how long are you planning to invest, and what kind of asset are you buying?
That last point on asset type is a really big deal, and this table shows you exactly why. For something with low volatility like a government bond, a 5% currency swing is a massive chunk of your total risk. Hedging there is a high priority. But for volatile stocks that are already bouncing all over the place, currency risk is a much smaller piece of the total risk pie. That makes the decision to hedge, well, less of a slam dunk.
So here's the bottom line. Hedging isn't just a simple on or off switch. It is a strategic choice. Are you playing defense, trying to lock everything down and remove all uncertainty? Or are you playing offense, leaving your portfolio unhedged, hoping the currency moves in your favor, or maybe even provides that natural cushion? We'll leave you with that question to think about for your own strategy.